The ECB, of course, very concerned about fragmentation, but there are different kinds of fragmentation. Which one is the ECB going to tolerate? Which one's the ECB not going to tolerate? Joining us now to discuss all of this, Bilal Hafeez, Macro Hive CEO and Head of Research. Bilal, the ECB has a problem next week. It's due to announce its fragmentation fighting tool. We now have fragmentation in the form of a political crisis in Italy. BTP bund spreads are widening out. Is this the kind of thing that the ECB is there to tackle? And how does it navigate it if it isn't?
I think it's very difficult for them. In some ways, officially, this is not what they're here to tackle. In reality, this is exactly what they're here to tackle, because Europe will never have a common fiscal policy, at least not in the near term, and the Germans would kind of object to that if there was formalized. So in the end, it's always the ECB that has to bail out Italy in some ways. So they'll have to come up with a fragmentation tool that will be sufficiently strong to calm the market down in the situation. So they have a big task next week to announce something big. If they don't, then we could really see Italian spreads blow out much more significantly than what we've seen already.
Bilal, some are talking about how there needs to be conditions attached to any kind of money or bond buying from this transmission protection mechanism. I've heard that before. I feel like we've heard, like, we'll help you, but ... There's going to be conditions. Can Italy survive something like that with those conditions? Like, will that actually do the job?
Well, I think the market would not like it if there were conditions attached. Of course, the OMT program, which was introduced a number of years ago, had conditions, and they haven't really used that since, especially since COVID, they introduced the APP program rather than using the OMT. On top of that, at least since COVID, they've suspended lots of the rules that were governing fiscal balances across Europe anyway. So if you did introduce conditions, if the fiscal rules are suspended anyway, then what's the meaning of those conditions? So I think there will be chatter from Germany in particular for some kind of conditionality, but in practice, I think there won't really be any conditions if there was some kind of bond buying program.
Anything positive to say about the European economy at the moment?
I think it's a good point. I mean, the positive would be that a lot of bad news, at least in the currency, is being priced in, and in Italy. So there's some scope for some, some upside surprises. But in general, I think everything is pretty bad right now. You know, there's the Italian political unrest, there's a gas issue, from Russia, there's a heat wave. Wherever you look, there's a problem in Europe. So it really is a dire situation right now.
So why is euro-dollar still at parity? Like, why aren't we materially below that?
Well, I mean, we have fallen to parity, so I think that's one thing. What's interesting is if you look over the past week or so, there has been some speculation that the ECB could be a bit more hawkish. So if you look at the behavior of bond yields in Europe, they have started to pick up somewhat. So the market became very dovish on the ECB. But over the past week, they've started to say, hang on, the ECB may actually start to raise rates. So that's something that's helping the euro. The other thing also from an investor perspective is it's very hard to trade the euro right now when you have this looming deadline on the Russian pipeline. Will the Russians restart gas in the pipeline or not? So if they do restart the gas, then euro could spike higher off the back of that. So we're in quite a tricky situation from a trading perspective.
And what happens on that front, do you think?
I think if they do restart the pipeline, then euro pops higher.
But do you think they're going to restart?
My base case is yes, they will. But I'm not an expert in reading Putin's mind. But my base case is they are likely to. Mainly because if you look at what Putin's done, he tends to strangely try to respect contracts. Whether he says, I want to pay back Russian debt, I think he wants to take the higher ground here and use this perhaps later as some bargaining chip. But who knows? I may be completely wrong here.
So is that what it would take, the Russian gas getting turned back on to that 40% of Nord Stream 1 where it was before, for the dollar to find its top?
I think temporarily that could be something, but I think bigger picture, in order for the dollar to find a top, what you need to see is the ECB really start to ramp up interest rates, because if they just raise rates by 25 basis points or even 50 and stop, that's not really enough when the Fed's potentially raising rates by 100 basis points at the next meeting. So there needs to be a bigger focus by the ECB on inflation, which strangely it hasn't really focused on as much because of the energy crisis.
Mr. Waller is speaking right now, talking about the fact that he's mainly focused at the moment, maybe not firmly focused, but focused on 75 rather than the 100. If the market opens the door to 100, though, would it be foolish for the Fed not to take it?
I think it would be foolish for them not to take it. You know, they surprised last time by raising 75 rather than 50. Yep. The Bank of Canada this week raised by 100, which was a surprise. And I do think that, given the data that we've seen, inflation just isn't peaking right now, that they have to go something like 100. And this is really the best time for them. In the data, payrolls was relatively strong, inflation's coming up much higher than expected, and they have to act. I mean, if you look in surveys across the US, still inflation is still a big political issue.
Do you think that, I love this is like rapid fire with Bilal, it's like how many questions can he answer? If you take a look at 100, is that fully priced into different markets and different asset classes, or is there still kind of a risk if they go on July 100 to the markets?
Yeah, I mean, I think markets are not fully pricing that. I think risk markets could go down more. The one challenge we have at the moment is what the market is trying to say with rates is that they may go 100, they may even, you know, raise 75 after that meeting, but then we'll have a recession and then the Fed will be cutting rates. And because of that ends up supporting risk markets. So we have this funny dynamic where an aggressive Fed may not necessarily end up leading to long-term yields going up that much. And as a result, risk markets get some support from that. I think that's not correct because I think the Fed will end up going a lot more aggressively, and the recession we're likely to get will probably be deeper than many people think.
Well, a lot of people are talking about a mild recession. We're kind of progressively going through the stages of denial around all of this, and we're now at the point of a mild recession.
Yeah.
The question around a mild recession, is it enough to get inflation out of the system?
Exactly, and I don't think it is right now. I mean, given the data we're seeing, given the scale of inflation, given how far behind the Fed is, behind the curve, normally when you have you know, very high inflation, the policy rate is usually the same level as inflation. So right now, in theory, the policy rate should be something like 7, 8, 9%, but we're way behind. And so if you are really far behind, then you have to jack up rates even more, which ends up inducing a much larger and deeper recession, which is exactly the problem Volcker had in the late 70s, early 80s, and we're kind of having a repeat of that right now.
Bilal, what's the thing that breaks the most? And I'm just looking at the Thai baht falling to the weakest level versus the dollar since 2006. Like that, the repercussions of that stronger dollar and what we're pricing in already with just a mild recession is already having big ramifications. What breaks the hardest?
Well, I think to start with, we're clearly seeing FX, you know, coming under significant pressure. So the dollar's going up a lot. Dollar Thai baht's one. Dollar South African rand, that's another one that's really moving to new highs. So the rand's weakening a lot. Dollar China is probably the interesting one to watch, whether we do move towards 680, 690, or even 7 or so. That, you know, as a major currency, that could be a big market mover. But then outside of that, more generally, I would say equities. You know, equities could see another 20% downside. You know, many people have seen a 20% correction in equities and thinking that this is the end of that correction. But if we were to see more Fed hikes, then I think equities could be seriously vulnerable.
But that doesn't happen for a while, because at the we're just talking to Mark Cabana of Bank of America. He's lowering his forecast for the US 10-year.
Yeah, I mean, I heard that sort of segment, and the view there is that there will be a recession, but implicit behind that view is that the Fed's not going to raise rates that much. You know, so the market's pricing the Fed to raise rates to 3.5, 3.75. I think is more likely to be higher than that, and that the Fed is much more willing to slow the economy down than people think. And I think that's the kind of misunderstanding or the mispricing right now.
Bilal, thank you very much indeed. Bilal Hafeez, Macro Hive CEO and Head of Research. As Alex says, quick fire questions. We covered a lot of ground there.